Hi, everybody. Today I'm going to address why with VIX low in the 11, 12 range, whatever, why do iron condors, excuse the word, why do they stink? And is there an alternative? Why do people get frustrated and they say, well, I can't do any range bound trades when VIX is low? I need high premium. I need high VIX levels. And that's, as my Irish grandmother would say, it's a bunch of malarkey. What can you do? Is there an alternative to iron condors when the VIX is low? Well, yes, there is. So let's take a look at this and address the problem. Here's an example of an iron condor about 5 weeks out. Oh, excuse me. I'm selling the 56.30 calls, and I'm selling the 52.60 puts within a half delta of neutrality, pretty neutral. And you can see when you go 5 weeks out, your gamma is pretty low, which just means is a quick and easy way for understanding gamma. Just your deltas don't change that much when you go up or down 1% in the underlying. Now, so when I look at this example, we're around 54.30 in SPX. There's a 5-week iron condor. What is an iron condor? I'm selling an out of the money call and put. What's that called? A strangle. And then in this example, I'm buying my hedges, my long options, approximately 10 points either way. But all of this is taking place in the same expiration, right? It's a credit spread. And you're basically putting on a high probability trade. You're basically saying SPX is here. We're not going to go beyond our short strikes. Anything in here percolates like a good cup of Folgers coffee. And you're making money of positive theta. Your shorts are going to decay quicker than your longs. You have probabilities in your favor, on and on and on. But it's a short vega trade. So that means if the volatilities of each of your 4 options goes down a point, theoretically you make $39. If the volatility of each of your options goes up a point, you would lose $39. But what people moan and complain about when the volatilities are low is what happens when the VIX is low is you're not getting as much credit that you would if VIX wasn't 12. If VIX was 18 or 19, you might get a better credit by a little bit, maybe in this case, maybe 260, 270, or 280. But the bigger thing that would be, instead of your graph looking like this, if the VIX were 18 instead of 12, your graph would look like this. It'd be extended out. You'd get a lot more room, and you'd feel like, wow, look at how much room you can drive a double wide trailer. You get a lot more room, so it feels better. You're getting a higher volatility, higher credit, and more room. So I said, well, Dan, what do I do when the volatility is low? Can I get that similar graph? Yeah, because you don't really want to be. You're not getting as much room. And if the market goes down and volatility goes up, that's hurting you. So what can you do? Well, the alternative or first cousin is a double diagonal, right? So, and it's not that, very similar. You're starting out with the foundation. We're selling a out of the money call. You're selling an out of the money put. In this case, it's the same expiration, July 19 for the shorts and the longs of an iron condor. But the double diagonal, I'll get to that in a second. So my shorts are this, literally I'm selling an out of the money call and put. So you get the probabilities in your favor, you get time decay in your favor, but it's long vega. So if each of your 4 options in a double diagonal go up a point, theoretically, you make $91 instead of losing it. But if the volatility comes down, you could lose 91. Now, in this case, what you see I did is what is a double diagonal? Double diagonal is just a mixed month spread with different strikes. Here I'm buying the July 26, and I'm selling the July 19. So my shorts are closer in expiration than my longs. And in this case, I'm selling a 53.30 call, July 19, and I'm buying a July 26, $55.50, 20 points further out of the money than my short call. On the put side, I'm selling the 54.10 puts in the July 19 expiration. I'm going further out. I'm going further out in the July 26 expiration. And I'm buying the 53.90 puts, 20 points further out of the money. So again, can you trade a strategy in a low vol environment? The Iron Condor strategy, which is basically selling an out of the money call and put and buying wings. Yeah, you just flip it. You do the first cousin, you do a double diagonal. Gives you good theta benefits if the volatility goes up. And so it's just learn to put another golf club in your golf bag. Learn to, another tool. And if you add double diagonals to your Iron Condor, then you can trade a range bound trade as long as the market's some type of range bound. Now you open up the possibilities. You can trade all the time. You don't have to wait and say, oh, credit spreads in Iron Condors, the VIX is low, I can't do anything till vol goes higher. That's absolutely wrong, right? These trades work great in a low vol environment. And again, not that you can't do Iron Condors in a low vol environment. They work very well. They work very well. But I think double diagonals are a much better way to skin the cat when volatilities are low. So folks, check us out at SheridanRiskManagement.com. And I think if you click on the tab on the top on subscription, we have for $194, you can get 2 to 2.5 hours of live content every day where we're looking at trade ideas, evaluating the news, looking at student trades. You have access to all our on-demand classes, everything. So it's a much cheaper model than anything I've been associated with, makes it more doable for people to come in. So our cost is $194 a month. If you email me at Dan at Sheridan Risk Management, I'll get you a coupon for $99 for a month so you can check it out. Have a good day, folks, and we'll see you later. Thanks.